And something else to think about too is the what we call the widow tax, which this doesn't even include that. But for married couples, one of you is going to be the survivor at some point in time. In most cases, there's going to be one of you that's the surviving spouse. Single filer tax brackets are a lot lower. So if your income is going to stay the same, or even go down just a little bit, your tax rate's going to go up. One of the strategies we like to use is Roth conversions or Roth IRAs, kind of carving those out into a bucket for the future spouse so that they don't have an increased tax bill at that point in time. And it's really just making sure that you're taking advantage of the strategies that are available so that you get to keep as much of the money that you've earned and saved as possible.
Ask Abby, providing answers, insights, and education designed to give you the tools and knowledge you need to thrive financially and live confidently in retirement.
And welcome into the Ask Abby podcast with Abby Reed of the Reed Financial Group, the retirement family, your resource, ladies and gentlemen, on proactive guidance on your money, your investments, your financial and retirement planning. Continuing our conversation, Abby, about some opportunities that we have as we close out what has been a pretty challenging financial and economic year. Welcome back. Always a pleasure to see you.
Great to be here, Peter. Yeah, it's always nice to be able to especially in a year like this year, to talk about some good news finally and some opportunities. And the stuff that's gone on this year has been hard for a lot of people. But we're here to talk today about the opportunities that might come from that. So that's always fun.
Absolutely. And ladies and gentlemen, you always have the opportunity to get your questions answered and addressed on an episode of Ask Abby, or individually and in person. If you'd like something addressed on air, if you'd like to hear a conversation or a topic discussed, go to goaskabby.com, and there's a great place right there at the top of the website where you can submit your question or a topic that you would like to hear and learn more about. Or you can give Abby Reed at the Reed Financial Group a call, 678-442-0255. That's 678-442-0255. And it's the time of year, a great time of year to get your review and update on your financial well-being, your plan, and your progress. See what progress you've made this year, what benchmarks and milestones you've accomplished, and set new ones for next year. So a lot of those strategy sessions going on there at the Reed Financial Group right now as we are closing in on the end of the year. And Abby, a lot of opportunities being identified and discussed for next year as well. One of the big ones, contribution limits for next year in our retirement accounts are on the rise.
Yes, absolutely. So that was some good news that came out last year. We were kind of speculating about what they might be because of inflation being so out of control this year. So what you can contribute to all different kinds of retirement accounts, health savings accounts, SEP IRA, the alphabet soup of different options there. Almost all of them across the board have gone up. And like the 401k, for example, has gone up by more than it has in a very long time. So that's an opportunity for people next year to maybe, if you're in a position to be able to contribute the max, which is a great position to be in. And for those people, go ahead and congratulate yourself. And, you've done well. And so go ahead and contribute the max if you can. It'll help you make up a little bit of what you've probably lost this year and those accounts. And also for people that are still in the accumulation phase. So maybe you're more than 10 years away from retirement, you're going to be in that stage where this is actually a good opportunity for you, because what you're doing is you're buying those shares or those funds or whatever you're invested in at a lower rate. So basically you're going to the market and everything's on sale right now, and it's cheaper than it was 2 years ago, which doesn't happen, as often as, we might think it happens. So it's a good opportunity. And then you can put even more money in there. So there's a lot of opportunities for next year.
Yeah. And over the course of my investing lifespan, I've seen it happen a few times, but it's a little bit more frequent than a once in a lifetime opportunity, maybe a once in a decade kind of opportunity where prices for our investments are on sale. So right
Yep.
now is the buy low, and hopefully into the future, as the market has previously done after challenging times, recovers and then rises above where it was previously, we can sell high into the future, right?
Right, exactly. And then also, so when this does happen again in the future, because we know that these things happen, they just do happen. You might be in a completely different situation. So, if you're however old you are now and this doesn't happen again for whatever 10 years, you might be you might be in the planning for retirement stage where you can't necessarily afford to take on as much risk, or your risk tolerance has gone way down. So it might not be the same type opportunity. So it's good to kind of understand what phase you're in and what's a risk and what's an opportunity, depending on what phase you're in.
Yeah, where you are in life and the direction of your money matters almost just as much as the direction of the market. So,
Yep.
an opportunity here, if you are making those contributions in the accumulation phase, those limits are going up. They went up this year, they're going up again next year, and we want to understand what those limits are, take full advantage now. Rightfully so, you congratulated folks who are in the position to take
Yes.
advantage of these increased limits. Those same people may also deserve a congratulations, Abby, for already building up some pretty significant balances in those retirement accounts. And again, a pat on the back to you, ladies and gentlemen. But for specifically those tax deferred retirement accounts, not only have we built up our investment value, but we've also potentially built up a rather large tax bill, Abby, and maybe a good opportunity to do something about that.
Right. So the age old wisdom and what, most people are taught for their entire lives is to, sock away as much as possible in those tax deferred accounts and get the match. And so they have this, I kind of like to describe it as like a snowball. So you start small, and everybody has to start somewhere. So you start small, and then as you start to continue on down that path, the snowball is getting bigger and bigger and bigger, which is great. That's compounding interest, especially with the matches that some people are getting. But what's also happening in that snowball is that the tax expense or the tax liability is growing as well. And so sometimes people don't really think about that until they're either right up against retirement or in retirement. It's one of the biggest concerns and complaints that we have with our older clients that have been in retirement for a while, that are high net worth. It's the taxes. A lot of people think that their taxes are going to go way down in retirement. That's not always the case, especially if you've accumulated most of your wealth in these tax deferred accounts. So what we're going to talk about today is what are the options for diversifying that a little bit. And one way to do that is Roth conversions, or potentially if you're under 59 and a half, and you can't do a rollover into an IRA, potentially you could do an in-plan conversion of some kind. It really depends on your situation, what your opportunities are, but that's the concept that we're going to go over today.
Now, when we are considering these kind of proactive tax moves, Abby, there's a bill that's going to be involved. There's a cost. It's pay me now, pay me later. You mentioned that a lot of people have saved under the premise and assumption, the teaching that we'll be paying lower taxes in the future, but that the snowball effect actually grows the size of whatever that tax bill is. A fact that I don't think was missed by the IRS, by the way. I think
they know what they're doing.
Yeah.
Right.
But it catches some of us by surprise.
Yep.
Now, we have to understand what the cost of that pay me now versus pay me later is going to be. And at Reed Financial Group, you guys have some pretty advanced capabilities of helping people to understand and quantify those costs.
Right. Exactly. So one thing that we think is really important to do is, well, first of all, education. I think that having, educated clients and providing education like that is going to allow our clients to feel more empowered, which brings peace of mind and better financial decisions in the long term. So one of the things that we like to do is kind of bust myths and misconceptions that are out there, and sometimes that requires us kind of proving it with the analysis or the math, so that people know that we're not making recommendations based on our opinions or how we feel about something. It's based on the math behind it and the facts behind it. And so this is an example of an analysis that we've done, of what's the true tax bill of a pretty significantly large IRA over time, and then what would be the tax bill for a large conversion. So this is an example, kind of like a case study of that that I think is really powerful and can really be kind of a paradigm shift for people. And I think it's important.
Yeah, well, you passed along several examples, but I'm going to pick one and focus on one, just so that there isn't a lot of different numbers being thrown about. But these are very customizable, and you do this for the individual or the couple's specific situation. You put in their amount. You can kind of show and project out what the RMDs might be, the tax rate and bracket that they are in. You can talk about variables such as the assumed growth rate. Do we want to be maybe aggressive and opportunistic, or more conservative in what we think the account is going to grow to in the future, and then quantify the numbers. So the theoretical kind of illustration that you sent was for a hypothetical 62-year-old couple with a $2 million tax deferred retirement balance. Again, a pat on the back to these folks. They did an excellent job. 22% tax bracket was the assumption, a 4.25% growth rate. So they were actually pretty conservative with their investment assumptions. And then a life expectancy out to 90. And what does the tax bill look like on that $2 million IRA balance? Well, if we take the RMDs, that's going to be $546,000 and some change in taxes. And then if we take those RMDs and reinvest them and then pay taxes again on the growth, that's another $198,000. And then the remaining balance that's left over when we pass away and pass on our IRA at 90 years old, well, there's another $391,000 in taxes passed along to our beneficiaries. I love that we can see this. I hate to see this bottom line on a $2 million IRA, the projected taxes on that out throughout our lifetime and on the inheritance, $1.136 million, over 50% of the current account balance we will actually pay in taxes over our lifetime. Again, I think the IRS understood that compounding snowball effect. Now, here's the real kicker, is that you also show strategies where we can control and minimize that tax bill and quantify the expense. And we can do as much or as little as we like, but when we see these numbers side by side, there is a stark difference. If we want to be proactive, we could potentially bring that bill down under that scenario to as low as $440,000 during our lifetime. So a significant savings. And these are the kind of things that you go through with clients, crunch the numbers and show them side by side to maybe let them make an educated, informed decision on their path moving forward.
Right. So what a huge difference between the lifetime expense of having a $2 million IRA. And this is, like you were mentioning, this is a conservative rate of return. And so if it was a larger rate of return, then this would be even more substantial. And especially also, so something that we like to talk about as well is the taxes of the beneficiaries of the IRA, because the new tax rules that happened with the Secure Act, we won't go into too many details, but they're going to have to empty these accounts a lot faster than they were going to. And this catches a lot of people by surprise. So especially with our clients that have that are planners and they've saved in their IRAs, and they were planning on giving, on that being the legacy and their kids being able to enjoy that for their lifetime. But now they have to empty that account within 10 years. And so that's, especially with a large IRA balance, that's a huge tax bill. And so that's something to think about as well. But right, so even if you do a large conversion, you convert all of it, which would be a pretty extreme example. But if you just bit the bullet and went ahead and converted it, that would be $440,000 in taxes for the IRA, as opposed to, almost $1.2 million in taxes over the life of this IRA.
Yeah. How would you like to save 60% on taxes on your retirement account, right?
Exactly.
The choice seems clear when we quantify it in such a way. And to your point about the inheritance, I think that there are some out there that say, well, if I'm leaving money behind, I'll leave them the tax problem to deal with as well. But very few people who were smart and frugal and hardworking and blessed enough to build up that kind of sizable balance to pass on. Very few people, I think, want to leave Uncle Sam and the IRS as their largest beneficiary. So again,
exactly.
Kind of just the information and then leaving it to the individual or the couple to make a well thought through and now more informed decision, seeing these kind of numbers side by side. Just part of the type of planning that you and the team at Reed Financial Group do for your clients and for listeners and viewers of the program.
Exactly. And something else to think about too is what we call the widow tax, which this doesn't even include that. But for married couples, one of you is going to be the survivor at some point in time. In most cases, there's going to be one of you that's the surviving spouse. And as we all probably know, single filer tax brackets are a lot lower. So if your income is going to stay the same or even go down just a little bit, your tax rate's going to go up. And so if you can, one of the strategies we like to use is Roth conversions or Roth IRAs, kind of carving those out into a bucket for the future spouse so that they don't have an increased tax bill at that point in time. So there's a lot of different ways to use this and think about it. And it's really just making sure that you're taking advantage of the strategies that are available so that you get to keep as much of the money that you've earned and saved as possible. And if you just imagine yourself filling out your beneficiary form and at the very top, that being, Uncle Sam or the IRS, not a fun visual at all. We all have to pay our fair share, but not more than we have to. And these strategies allow us to take advantage of the tax code and what's allowed, and help our clients to keep more of what's theirs.
Yeah. When we say Uncle Sam, I think the visual is that the guy with the white beard and the stars and stripes hat and outfit pointing, saying he wants you.
Right.
But the IRS, they want your tax dollars, right?
Yep,
and we don't want to leave them more than their fair share. And we have been taught, and for many of us done very well in building this balance to support ourselves and create a lifestyle in retirement. But for many, many of us, that is yet to be tax deferred, and the IRS has not forgotten about a single cent of it. So we need to quantify that. We need to understand. And ladies and gentlemen, there are opportunities to control and minimize that ultimate tax liability. That's what you need to know and take away from Abby Reed on this episode of the program. And if you'd like to see that for your situation, if you'd like to apply it to your specifics, pick up the phone and give Abby Reed at Reed Financial Group a call, 678-442-0255, 678-442-0255, or you can go to goaskabby.com to request a time to speak with Abby Reed and go over your situation or answer your questions. Now, you also mentioned before the program, Abby, that it may actually be a painful time to make these kind of considerations because of the volatile year that we've had, but it actually may make it more opportune as well.
Yes. So it's one of those counterintuitive things that is, I don't know if finance is unique in this or not, but it just seems like a lot of things are kind of counterintuitive to what most people think. So doing a large Roth conversion or any Roth conversion right now, it just seems to some people like kind of adding to their pain a little bit. Why would I want to sign up for a larger tax bill than necessary right now, especially on top of maybe having some losses in your account, or some people even having pretty significant losses in their accounts. So what we explain to people and what we educate on is market volatility. So a loss in those accounts is actually going to create an opportunity for you to convert a larger percentage of your account at a lower value. You're going to keep those funds invested. It's just going to be under a Roth IRA umbrella instead of an IRA or 401k umbrella. And once the market does come back eventually, you're going to be able to enjoy all of those tax-free earnings that are going to happen at some point in time. So we know the market's going to come back. And when it does, and as it does over time, all of those earnings are going to be tax-free, which is a huge benefit. And it's an opportunity that is unique to years that are down.
Yeah. And I'm going to put this in terms that I can understand, add or take away as many zeros as you would like, ladies and gentlemen. But if I had $100, for instance, in my IRA, to move it over to a Roth might cost me $20. That's the tax that I would need to pay on that $100. By the way, if I wanted to take it and spend it, it would cost me the same $20. Right. That's the nature of IRAs. But if I wanted to move it over to a Roth IRA, it might cost me $20. Well, if the market has lost 20%, my $100 is now $80. Now that same $20 payment converts over 25% of my total account balance rather than just 20 before. It does a larger portion of the account, which now can recover eventually in the Roth IRA side tax-free for me so that I can spend it in the future without having to pay taxes.
Yep, exactly.
So,
and also to go back to what we talked about at the beginning, the tax bracket changes and some of the changes that are happening next year. We'll get into the details of that, maybe another time closer to that. But there is an opportunity there for you're going to be able to have more income at lower tax rates. And so the opportunity for tax rates or the opportunity for Roth conversions next year is going to be good as well. So you're going to be able to convert more and stay in the same bracket or potentially stay in a lower bracket as another opportunity.
Informed people make better decisions, and that's why we count and rely on the guidance of Abby Reed from the Reed Financial Group, the retirement family. If you've got questions, if you would like to do some of that proactive planning to make sure that you've got a plan and understand what it takes to execute and meet your goals into the future, pick up the phone and have a conversation. No cost, no obligation. Ask your questions, get your answers, get that plan put together, review and evaluate your current investments and retirement accounts and portfolio, and understand better what each and every dollar and position and investment and account is doing for you. 678-442-0255, 678-442-0255, or you can visit online, goaskabby.com, goaskabby.com, where you can submit questions that you'd like to hear addressed on the program there as well. Abby, always a pleasure. Thank you for the continued reminders on these important topics, things that we can control in our financial future, strategies that we can take advantage of. It's always a pleasure having you on the program.
Absolutely. Always a pleasure to be here. And this is some great information for people. So I appreciate the conversation, and I'll talk to you soon.
Here to answer your financial questions, visit the website goaskabby.com for show resources and to submit your questions and get answers, or to schedule your complimentary financial investment and retirement planning strategy session. You can also reach out to Abby directly at 678-442-0255. That's 678-442-0255, or at goaskabby.com.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and Reed Financial Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Third-party ratings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.